ExamPrep.School. Accredited Investment Fiduciary exam code ANSI and ANAB. There are 4 practice exams in this series. This video covers Practice Exam 1, which is free. In this video, we will be covering the following major categories for Practice Exam 1. Formalize. The investment policy is consistent with objectives for the portfolio and risk and return assumptions. Implement decisions regarding investments and services are implemented in accordance with the duties of loyalty and care. Monitor. The portfolio is monitored regularly to ensure consistency with benchmarks and overall objectives. Organize. Fiduciary roles and responsibilities are clearly documented and defined. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Under ERISA, which of the following individuals meets the definition of a fiduciary based solely on the nature of their functions? A consultant compensated for providing investment recommendations to a plan sponsor. B, a claims administrator handling benefit distributions without offering investment advice. C, a plan trustee appointed by participants but lacking discretionary authority. D, an employer selecting an insurance carrier for group coverage without fee-based counsel. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is A. The correct answer is a consultant paid to give investment advice, because ERISA defines a fiduciary by providing investment recommendations for a fee or other compensation. Reason B is not correct. A claims administrator processing benefits without investment advice does not meet the advice-based fiduciary definition. Reason C is not correct. A trustee without discretionary authority cannot be a fiduciary under ERISA, even if appointed by participants. Reason D is not correct. Selecting an insurance carrier without providing paid investment counsel does not trigger fiduciary status. Question 2. Which statement most accurately distinguishes the prudent expert standard from the prudent person rule? A, the prudent expert standard requires reliance on external experts. The prudent person rule mandates all decisions made internally. B, the prudent expert standard applies only to ERISA. The prudent person rule is universal for all investment contexts. C, the prudent expert standard holds fiduciaries to seek expertise and exercise care accordingly. The prudent person rule demands conduct as a reasonable individual. D, the prudent expert standard sets quantitative benchmarks. The prudent person rule emphasizes qualitative guidelines. The correct answer is C. The correct answer defines the prudent expert standard as requiring fiduciaries to use professional expertise and prudent processes, whereas the prudent person rule is based on how a reasonable individual would act. Reason A is not correct. The prudent expert standard does not forbid internal decisions, nor does the prudent person rule require all decisions be made internally. Reason B is not correct. Both standards can apply under ERISA. The prudent person rule is not strictly universal outside ERISA. Reason D is not correct. Neither standard is solely about quantitative versus qualitative benchmarks. Both involve a duty of care. Question 3. The duty of loyalty under ERISA requires fiduciaries to act for the exclusive purpose of providing benefits and defraying reasonable expenses. Which scenario most clearly constitutes a violation of this duty? A fiduciary selecting a lower-cost investment option for plan participants. B, an advisor avoiding investments managed by a related party to prevent conflicts. C, a trustee obtaining competitive bids before hiring a record keeper. D, a plan administrator using plan assets to cover personal travel expenses. The correct answer is D. The correct answer involves using plan assets for personal travel, which breaches the duty of loyalty by benefiting the fiduciary rather than participants. Reason A is not correct. Selecting a lower cost option benefits participants and does not violate loyalty. Reason B is not correct. Avoiding related party investments reduces conflicts and upholds loyalty. Reason C is not correct. Obtaining competitive bids demonstrates loyalty by seeking best interests. Question 4. During a quarterly review, a pension plan committee relied solely on its external consultant's summary reports without examining underlying fund prospectuses, and the plan incurred significant losses when market volatility spiked. Which action best reflects a fiduciary exercising the duty of care and prudence? A. Conduct independent analysis of each fund's objectives, fees, and performance before making recommendations. B. Continue relying solely on consultant reports to streamline decision-making. C. Increase allocations to higher-risk funds in hopes of recouping losses. D. Immediately replace the consultant without evaluating the current investment lineup. The correct answer is A. The correct answer is conducting independent analysis because it demonstrates the fiduciary's obligation to perform due diligence and understand investment details, fulfilling the duty of care and prudence. Reason B is not correct. Relying solely on consultant reports neglects the fiduciary's responsibility to verify information personally. Reason C is not correct. Shifting to higher risk funds without analysis contradicts prudent risk management practices. Reason D is not correct. Replacing the consultant without evaluating the existing investments bypasses the obligation to understand plan holdings. Question 5. A trustee overseeing an endowment fund holds 90% in a single domestic equity index because of familiarity and 10% in cash. According to the duty to diversify, which portfolio adjustment best mitigates investment risk? A. Shift 50% of assets into a broad-based domestic equity index fund. B. Maintain current allocations but add more cash equivalents for liquidity. C. Rebalance the portfolio to include international equities, bonds, and alternative assets. D. Concentrate investments further in top-performing domestic sectors for higher returns. The correct answer is C. The correct answer is rebalancing across multiple asset classes because it spreads exposure to different market drivers and reduces concentration risk, satisfying the duty to diversify. Reason A is not correct. Moving within the same equity class fails to diversify across different risk factors. Reason B is not correct. Adding more cash equivalents does not meaningfully diversify market exposures. Reason D is not correct. Further concentration increases risk and contradicts the principle of diversification. Question 6. A plan co-fiduciary delegates investment decisions to a fellow fiduciary and never reviews performance reports. When the strategy underperforms, the plan suffers losses. What most directly triggers co-fiduciary liability in this scenario? A. Failing to fully delegate investment authority through a written agreement. B. Investing in underperforming assets instead of replacing the co-fiduciary. C. Delegating decisions without periodic oversight of the co-fiduciary's actions. D. Holding the co-fiduciary harmless for all investment outcomes. The correct answer is C. The correct answer is the lack of periodic oversight, since co-fiduciary liability arises when a fiduciary fails to monitor or intervene in another fiduciary's actions. Reason A is not correct. Co-fiduciary liability is based on failure to monitor, not merely the absence of formal delegation documents. Reason B is not correct. Liability stems from a lack of oversight, not from choosing to retain underperforming assets. Reason D is not correct. Agreeing to hold harmless does not negate the duty to supervise delegated responsibilities. Question 7. Under ERISA, Plan Document Hierarchy Rules, which of the following documents has the highest authority when resolving conflicts among plan-related documents? A. The formally adopted investment policy statement. B. The summary plan description document. C. The formal trust agreement instrument. D. The original written plan document. The correct answer is D. The original written plan document is the controlling document in the hierarchy and prevails over SPDs, trust agreements, and IPS provisions when conflicts arise. Reason A is not correct. An investment policy statement is subordinate to the plan document and is used for guidance, not conflict resolution authority. Reason B is not correct. A summary plan description summarizes provisions but does not override the written plan document. Reason C is not correct. A trust agreement governs trust mechanics but yields to the plan document in case of conflicts. Question 8. Which of the following best describes the trustee's investment authority as defined in a typical retirement plan trust agreement? A. The trustee has discretionary authority to invest plan assets under the trust agreement. B. The trustee may invest plan assets solely in employer securities. C. The trustee must follow formally established investment guidelines by plan participants. D. The trustee holds exclusive authority to appoint qualified investment managers. The correct answer is A. The trust agreement typically grants the trustee discretionary authority to invest plan assets, subject to the terms and limitations set forth in the agreement. Reason B is not correct. A trustee is not limited to investing only in employer securities unless specifically restricted by the plan. Reason C is not correct. Investment guidelines set by participants are subordinate to the trustee's discretion under the trust agreement. Reason D is not correct. While trustees can appoint managers, they usually retain direct investment discretion as defined in the trust agreement. Question 9. The Board of Trustees has drafted an investment committee charter that details member qualifications, meeting frequency, and reporting protocols, but lacks a mechanism to mitigate personal biases among committee members. Which provision is most critical to add to the charter? A. Definition of quorum requirements to validate committee decisions. B. Formal conflict of interest disclosure and recusal procedures. C. Escalation protocol for disputes over asset allocation recommendations. D. Guidelines for periodic performance measurement of managed portfolios. The correct answer is B. The conflict of interest disclosure and recusal procedures are essential for ensuring impartial decision-making and are required by fiduciary best practices, whereas the other provisions, while important, do not directly address personal bias. Reason A is not correct. Quorum requirements validate meetings but do not address individual member biases. Reason C is not correct. An escalation protocol manages disagreements but doesn't prevent conflicts of interest. Reason D is not correct. Performance measurement guidelines track results but don't govern member impartiality. Question 10. A corporate board has delegated routine investment oversight to its standing committee but wishes to retain certain prerogatives. Which action should remain exclusively under full board authority despite the delegation? A. Approving quarterly performance reports prepared by the committee. B. Amending the investment policy statement governing asset strategy. C. Selecting individual equity or fixed income securities for the portfolio. D. Setting interim risk tolerance thresholds within approved ranges. The correct answer is B. Amending the investment policy statement is a fundamental governance decision that defines the fiduciary framework and cannot be delegated, whereas the other actions are operational or procedural and fall within committee purview. Reason A is not correct. Reviewing performance reports is a delegated oversight function and not a governance foundational change. Reason C is not correct. Individual security selection is operational and typically delegated to professional managers or committees. Reason D is not correct. Adjusting within pre-approved risk ranges is a routine committee responsibility. Question 11. An authority matrix shows that the chief investment officer can authorize up to $5 million in commitments, the chief financial officer up to $10 million, and amounts above $10 million must go to the board. The matrix omits approval authority for the compliance officer, who oversees regulatory adherence. How should the authority matrix be revised? A. Assign compliance officer approval for transactions between $2 million and $5 million to monitor regulatory risk. B. Include compliance officer as an approver alongside the chief financial officer for commitments up to $10 million. C. Designate the compliance officer to review all board-level commitments over $10 million. D. Grant compliance officer veto power on all investment decisions irrespective of amount. The correct answer is B. Including the compliance officer alongside the CFO for approvals up to $10 million ensures regulatory oversight is integrated with financial review, while the other options either overextend the compliance role or underutilize it relative to the matrix thresholds. Reason A is not correct. Limiting compliance to lower-tier transactions underutilizes its role in mid-range approvals. Reason C is not correct. Regulatory review of board-level commitments alone fails to embed oversight at earlier thresholds. Reason D is not correct. A veto on all decisions is inconsistent with an authority matrix's delegation structure. Question 12. A retirement plan's investment policy statement prioritizes total return, but its governing plan documents emphasize capital preservation for near-term liabilities. What adjustment to the IPS best aligns it with the plan documents? A. Increase the strategic allocation to equities to balance long-term return goals. B. Add a secondary objective targeting income generation through high-yield assets. C. Incorporate a liability-driven investment objective emphasizing preservation over growth. D. Introduce a benchmark indexing strategy focused on market cap weighting. The correct answer is C. Embedding a liability-driven objective that emphasizes preservation ensures the IPS reflects the plan's near-term liability focus, whereas the other options either shift risk exposure or emphasize growth and income, misaligned with preservation objectives. Reason A is not correct. Boosting equity allocation elevates return focus and volatility, counter to capital preservation. Reason B is not correct. Targeting high-yield income increases risk, conflicting with preservation priorities. Reason D is not correct. Market cap indexing does not specifically address preservation of near-term liabilities. Question 13. Which element is an essential component of a comprehensive firm conflict of interest policy addressing potential conflicts between employee interests and client activities? A. Procedures requiring employees to disclose any personal investment interests that could conflict with client accounts. B. Guidelines for setting performance benchmarks for client portfolios. C. Standardized asset allocation models for diversified portfolios. D. Formats for periodic financial statement presentation. The correct answer is A. The correct answer is procedures requiring employees to disclose personal investment interests because these disclosures allow the firm to identify and manage potential conflicts, ensuring fiduciary responsibilities are upheld. Reason B is not correct. Guidelines for performance benchmarks relate to investment objectives, not conflict identification or management. Reason C is not correct. Asset allocation models address portfolio strategy rather than conflict of interest procedures. Reason D is not correct. Financial statement presentation formats are reporting standards unrelated to conflict disclosures. Question 14. Under standard fiduciary conflict of interest policies, employees must report gifts and entertainment received from a single outside provider over a calendar year when the aggregate value exceeds which of the following thresholds? A. $50. B. $100. C. $250. D. $500. The correct answer is B. The correct answer is $100 because most fiduciary policies set a nominal annual threshold at which gifts and entertainment must be disclosed to prevent undue influence from service providers. Reason A is not correct. A $50 threshold is lower than common policy standards and would be overly restrictive for most firms. Reason C is not correct. A $250 threshold exceeds the typical nominal value set to minimize influence without being burdensome. Reason D is not correct. A $500 threshold is too high for initial disclosure requirements under standard fiduciary guidelines. Question 15. A corporate retirement plan fiduciary learns that the plan's investment advisor affiliate is offering proprietary mutual funds with higher expense ratios than comparable third-party funds. To mitigate potential conflicts of interest and comply with fiduciary duties, which control measure should the fiduciary prioritize? A. Establish an independent committee to review and approve all affiliated transactions. B. Require affiliate products to undergo identical due diligence as external investment options. C. Document pricing comparisons for all affiliate investment offerings. D. Limit selection of affiliate funds to only actively managed strategies. The correct answer is A. The correct answer is to establish an independent committee, as that ensures unbiased review and approval of affiliate transactions, fulfilling the duty to avoid self-dealing. Reason B is not correct. Requiring identical due diligence is beneficial, but does not ensure unbiased approval separate from affiliate influence. Reason C is not correct. Documentation alone does not provide independent oversight or preventative control against conflicts. Reason D is not correct. Arbitrarily limiting affiliate fund types fails to address the governance of conflicts across all offerings. Question 16. During a fiduciary review, a 401k plan sponsor discovers that the plan's record keeper retains revenue-sharing payments from certain mutual funds without participants' awareness. Which action best addresses this disclosure lapse under fiduciary obligations? A. Amend plan documents to prohibit revenue-sharing arrangements. B. Terminate all mutual funds that pay revenue sharing immediately. C. Redirect revenue sharing payments to the plan sponsor unilaterally. D. Disclose revenue sharing arrangements to participants and negotiate lower payments. The correct answer is D. The correct answer is to disclose revenue sharing practices and seek reduced payments, fulfilling the duty of loyalty through transparency and fee minimization. Reason A is not correct. Prohibiting all revenue sharing may be overly restrictive and could limit access to cost-effective funds. Reason B is not correct. Terminating all revenue sharing funds may harm diversification and plan objectives without proper participant consent. Reason C is not correct. Redirecting payments without disclosure shifts benefits but fails to inform participants as required. Question 17. A plan fiduciary reviews share classes offered in the 403(b) plan and notes certain classes impose 12b(1) distribution fees. To align with duties of loyalty and care, what is the most appropriate fiduciary action? A. Replace share classes with equivalent no-load shares lacking 12b(1) fees. B. Require participants to opt in before investing in share classes with 12b(1) fees. C. Renegotiate 12b(1) fees with the fund issuer to a reduced level. D. Disclose 12b(1) fee impact in the annual participant fee disclosure. The correct answer is A. The correct answer is to replace share classes with no-load shares that eliminate 12b(1) fees, thereby reducing costs and fulfilling the duty of loyalty. Reason B is not correct. Requiring opt-in may not sufficiently protect participants and can be administratively burdensome. Reason C is not correct. Renegotiation may not be feasible if issuer policies prohibit altering established fees. Reason D is not correct. Disclosure alone does not remove ongoing unnecessary fees from participant accounts. Question 18. Which of the following is a core component that must be specified in a fiduciary service agreement's scope of deliverables? A. List of prohibited investment types. B. Performance metrics and reporting frequency. C. Detailed custodial transaction processes. D. Internal audit and control procedures. The correct answer is B. The correct answer is performance metrics and reporting frequency because fiduciary service agreements must clearly define the specific deliverables, including how performance will be measured and reported. Other items are either covered in different documents or pertain to internal governance rather than the service deliverables. Reason A is not correct. List of prohibited investment types is typically included in an investment policy statement, not in the service agreement's deliverables section. Reason C is not correct. Detailed custodial transaction processes are covered by custodial agreements rather than fiduciary service agreements. Reason D is not correct. Internal audit and control procedures relate to operational governance and are not standard service deliverables. Question 19. Under ERI, SA Section 408, subsection B, paragraph 2, which of the following must a covered service provider disclose to a plan fiduciary in its initial and annual fee disclosures? A. Projected plan asset performance over the next 5 years. B. Internal compliance policies of the plan sponsor. C. Demographic projections of plan participants. D. Indirect compensation arrangements received from third parties. The correct answer is D. The correct answer is indirect compensation arrangements received from third parties. Because ERISA Section 408, subsection B, paragraph 2, requires disclosure of all direct and indirect compensation the service provider expects to receive. The other items are not mandated disclosures under this regulation. Reason A is not correct. Projected plan asset performance is not a required element of the ERISA Section 408, subsection B, paragraph 2, fee disclosure. Reason B is not correct. Internal compliance policies of the plan sponsor are not required to be disclosed by the service provider under ERISA, Section 408, subsection B, paragraph 2. Reason C is not correct. Demographic projections of participants are not part of the required fee disclosures under ERISA, Section 408, subsection B, paragraph 2. Question 20. A plan fiduciary is reviewing a proposed custodial agreement to confirm that plan assets will remain protected if the custodian becomes insolvent. Which control feature should be included in the agreement to best achieve this objective? A. Asset segregation provision. B. Subcustodial delegation clause. C. Netting arrangement clause. D. Proxy voting authorization. The correct answer is A. The correct answer is the asset segregation provision because it ensures that client assets are held separately from the custodian's own assets, protecting them in case of custodian insolvency. Reason B is not correct. This is wrong because a subcustodial delegation clause permits appointing additional custodians, but does not protect assets if the primary custodian fails. Reason C is not correct. This is wrong because a netting arrangement clause focuses on offsetting obligations rather than safeguarding client assets. Reason D is not correct. This is wrong because proxy voting authorization governs voting rights, not the protection of assets upon insolvency. Question 21. A fiduciary negotiating a fund service agreement is particularly concerned that the custodian be held accountable for any losses caused by its negligence. Which clause should be prioritized to address this concern? A. Limitation of liability clause. B. Set-off clause. C. Force majeure clause. D. Indemnification clause. The correct answer is D. The correct answer is the indemnification clause because it obligates the custodian to reimburse the fund for losses resulting from the custodian's negligence or wrongful acts. Reason A is not correct. This is wrong because a limitation of liability clause caps total exposure rather than obligating reimbursement for negligence. Reason B is not correct. This is wrong because a set-off clause allows offsetting obligations, not reimbursement for negligent acts. Reason C is not correct. This is wrong because a force majeure clause addresses uncontrollable events, not negligence-related losses. Question 22. After poor service performance, a fiduciary plans to terminate its current investment manager and wants to ensure a seamless transfer of assets and records. Which termination provision should be included in the agreement to best support this objective? A. Confidentiality clause. B. Severability clause. C. Non-solicitation clause. D. Transition assistance clause. The correct answer is D. The correct answer is the transition assistance clause because it requires the outgoing manager to provide services and documentation necessary for a smooth handover of assets and records. Reason A is not correct. This is wrong because a confidentiality clause protects information, not the actual transfer process. Reason B is not correct. This is wrong because a severability clause concerns contract enforceability, not transition support. Reason C is not correct. This is wrong because a non-solicitation clause governs hiring restrictions, not asset handover. Question 23. Which of the following best defines an absolute return objective? A. Outperforming a specified market benchmark index. B. Achieving a predetermined fixed return target regardless of market conditions. C. Exceeding the median return of a peer group. D. Matching the performance of a particular sector index. The correct answer is B. The correct answer is an objective that seeks a fixed return target without reference to any benchmark. Absolute return objectives focus on achieving that specified level regardless of market performance, whereas the other options compare performance to benchmarks or peer groups. Reason A is not correct. Outperforming a specified market benchmark index is characteristic of a relative return objective that measures performance against an index. Reason C is not correct. Exceeding the median return of a peer group refers to a relative objective focused on peer comparisons, not a fixed target. Reason D is not correct. Matching the performance of a particular sector index is another form of a relative objective tied to an index benchmark. Question 24. Which statement most accurately describes a growth-oriented investment objective? A. Preserving capital with minimal fluctuation. B. Maximizing long-term capital appreciation through acceptance of higher volatility. C. Generating returns sufficient to maintain purchasing power. D. Matching risk-adjusted returns of a fixed income benchmark. The correct answer is B. The correct answer emphasizes long-term capital appreciation and the willingness to accept higher volatility, which defines growth objectives. The other choices describe preservation, inflation protection, or relative benchmark targets rather than a pure growth focus. Reason A is not correct. Preserving capital with minimal fluctuation is indicative of a capital preservation objective, not a growth objective. Reason C is not correct. Focusing on returns sufficient to maintain purchasing power describes an inflation protection objective rather than growth. Reason D is not correct. Matching returns of a fixed income benchmark is a relative return goal, not a growth-oriented objective. Question 25. A public pension fund is updating its IPS, which must specify an inflation assumption for discounting long-term liabilities. The current 10-year break-even inflation rate implied by TIPS is 2.2%, while consensus economists forecast project 2.8%. Considering the fiduciary's objective to align assumptions with market signals, which inflation assumption is most appropriate? A. 2.8%, reflecting economist consensus forecasts. B. 2.2% based on 10-year TIPS break-even rates. C. 3.0% equal to the historical 30-year average. D. 2.5%, the trimmed mean of recent forecasts. The correct answer is B. This option is correct because it aligns the IPS with current market-based expectations, ensuring consistency between assumed inflation and security pricing in the discount rate. Reason A is not correct. Consensus forecasts may lag market changes and do not directly reflect current investor expectations. Reason C is not correct. Using the historical 30-year average can misrepresent near-term inflation dynamics and produce a mismatch with liability valuations. Reason D is not correct. A trimmed mean of forecasts introduces subjectivity and diverges from objective market measures. Question 26. An endowment for a university has an IPS spending policy goal of preserving real value over time. The governing board is considering a 4% rule versus a 5% rule with a 3-year smoothing mechanism. Which policy best balances current spending needs with long-term purchasing power preservation? A. A flat 4% annual distribution without smoothing. B. A flat 5% annual distribution without smoothing. C. A 4% rule with a 3-year moving average smoothing adjustment. D. A 5% rule with a 3-year moving average smoothing adjustment. The correct answer is D. This option is correct because a 5% base distribution, coupled with smoothing, supports spending flexibility while preserving purchasing power by mitigating market volatility over multiple years. Reason A is not correct. A flat 4% without smoothing may underutilize assets and reduce real spending over time. Reason B is not correct. A flat 5% without smoothing exposes the endowment to more volatility and potential principal erosion. Reason C is not correct. While smoothing reduces volatility, a lower spending rate may not meet the university's current funding needs. Question 27. A family trust must provide an annual income of $200,000 and maintain liquidity for a potential $500,000 home purchase in 2 years. Which portfolio structure best addresses both income needs and near-term liquidity buffer requirements? A. Allocate a 6-month cash reserve plus laddered high-quality bonds and invest remainder in equities. B. Maintain all assets in a diversified equity portfolio and rebalance annually. C. Hold 50% in cash equivalents and 50% in long-duration bonds. D. Invest fully in dividend-paying stocks with a 6-month cash overlay. The correct answer is A. This option is correct because it ensures immediate income via cash reserves and bond ladders, while allocating remaining assets to growth for future needs, balancing liquidity and return. Reason B is not correct. A pure equity portfolio could fail to provide stable income and adequate near-term liquidity. Reason C is not correct. Holding half in cash equivalents is inefficient for generating required income or growth. Reason D is not correct. Dividend stocks may not provide reliable cash for the home purchase within 2 years. Question 28. A university endowment plans to segment its portfolio by time horizon: immediate 1 through 3 years, intermediate 3 through 7 years, and long-term 7+ years. Which approach most effectively matches asset classes to each horizon segment? A. Use cash for immediate, intermediate duration bonds for intermediate, and equities for long terms. B. Allocate equities to immediate, real estate to intermediate, and private equity to long term. C. Hold treasury bills for immediate, high-yield bonds for intermediate, and commodities for long term. D. Maintain liquid alternatives for immediate, emerging market debt for intermediate, and cash for long term. The correct answer is A. This option is correct because cash meets short-term needs, bonds match intermediate liabilities, and equities align with long-term return objectives and risk tolerance. Reason B is not correct. Equities in the immediate bucket risk selling during market downturns and impair liquidity. Reason C is not correct. High-yield bonds may lack principal protection needed for intermediate liabilities, and commodities carry high volatility. Reason D is not correct. Liquid alternatives may underperform cash for immediate needs and cash for long-term sacrifices growth potential. Question 29. A taxable individual at a 35% marginal rate is constructing an IPS and must specify tax constraints. Which guideline most effectively enhances after-tax returns? A. Include a target allocation to municipal bonds immunized against state taxes. B. Favor high-yield corporate bonds for income, regardless of tax status. C. Use a mix of taxable treasuries and REITs without tax-advantaged overlay. D. Allocate 100% to tax-advantaged retirement accounts without taxable holdings. The correct answer is A. This option is correct because municipal bonds provide income exempt from federal and potentially state taxes, improving after-tax yield for high-bracket investors. Reason B is not correct. High-yield corporate bonds generate taxable income that lowers after-tax return for investors in high brackets. Reason C is not correct. REIT dividends and treasury interest are taxable at ordinary rates, reducing after-tax yield. Reason D is not correct. Avoiding taxable holdings entirely may limit diversification and liquidity outside retirement accounts. Question 30. Which statement best differentiates investor risk capacity from risk tolerance? A. Risk capacity describes the investor's comfort with market fluctuations, whereas risk tolerance is the investor's ability to absorb financial losses. B. Risk capacity is the investor's objective ability to endure potential financial losses, whereas risk tolerance is the investor's subjective emotional willingness to accept volatility. C. Risk capacity remains constant over an investment horizon, while risk tolerance directly varies with market conditions. D. Risk capacity reflects historical investment performance, whereas risk tolerance is based solely on future return expectations. The correct answer is B. The correct answer is the one that states risk capacity as an objective measure of financial loss absorption and risk tolerance as an emotional preference, accurately capturing their distinct definitions. Reason A is not correct. This choice reverses the definitions by describing capacity as comfort and tolerance as loss absorption, which is incorrect. Reason C is not correct. Risk capacity can change over time with circumstances, and risk tolerance may also shift, so this rigid contrast is inaccurate. Reason D is not correct. Risk capacity is not derived from past performance, and risk tolerance involves more than just return expectations. Question 31. Which validity limitation is most applicable to risk tolerance questionnaires that present hypothetical asset allocations? A. Content validity, the degree to which the questionnaire covers all relevant aspects of risk behavior. B. Face validity, the extent to which items appear relevant to respondents without deeper analysis. C. Predictive validity, the ability of questionnaire scores to forecast actual future risk-taking behavior. D. Construct validity, the degree to which the instrument measures the underlying theoretical trait of risk tolerance. The correct answer is C. The correct answer is the one that highlights predictive validity, as hypothetical scenarios may not accurately predict an investor's real-world decisions under stress. Reason A is not correct. Content validity refers to coverage of topics, not the questionnaires forecasting accuracy. Reason B is not correct. Face validity concerns perceived relevance at face value rather than predictive power. Reason D is not correct. Construct validity deals with measuring the intended theoretical concept, not predictive forecasting. Question 32. A portfolio's historical return data shows the annualized standard deviation for two 5-year periods. Period 1, 2010 through 2014, 9%. Period 2, 2015 through 2019, 14%. Both periods had identical average returns of 7%. Based solely on this change in volatility, which implication is most valid for future risk assessment? A. the probability of extreme portfolio outcomes has likely increased. B. The correlation of returns with the market has likely decreased. C. The expected return of the portfolio has likely risen. D. Comparing sharp ratios across periods is not possible. The correct answer is A. The correct answer is that higher standard deviation implies a wider dispersion of returns, increasing the likelihood of extreme gains or losses. Reason B is not correct. Standard deviation shifts do not convey information about correlation changes. Reason C is not correct. Volatility changes do not determine shifts in expected return. Reason D is not correct. Sharp ratios can be compared if using consistent risk-free rates and periods. Question 33. A defined contribution plan manager reviews a portfolio with a standard deviation of 12% and a downside deviation, measured relative to a 0% floor, of 8%. When the manager is concerned only with returns below the target threshold, which inference is most appropriate? A. The dispersion of returns below the threshold is lower than overall volatility. B. Standard deviation understates total risk by excluding upside variability. C. Downside deviation places greater weight on positive return fluctuations. D. If returns are symmetrically distributed, downside deviation always exceeds standard deviation. The correct answer is A. The correct answer is that downside deviation isolates variability below the target, showing that downside dispersion is indeed lower than total volatility. Reason B is not correct. Downside deviation excludes upside variation and thus is lower than total volatility, not understated. Reason C is not correct. Downside deviation ignores positive outcomes entirely. Reason D is not correct. With symmetric distributions, downside deviation equals standard deviation, not exceeds it. Question 34. A pension fund targets a 7% annual return. Historical data indicate an expected return of 8% with a standard deviation of 10%, both assumed normally distributed. Based on the shortfall probability concept, what is the approximate probability that the fund's return will fall below the 7% target? A. 16%, B. 84%, C. 32%, D. 46%. The correct answer is D. The correct answer is the probability that a normal variable falls more than 0.1 standard deviations below its mean, which is approximately 46%. Reason A is not correct. 16% corresponds to a 1 standard deviation move, not 0.1 SD. Reason B is not correct. 84% represents the probability of exceeding 1 standard deviation below the mean. Reason C is not correct. 32% is the probability between the mean and 1 standard deviation below. Question 35. A scenario analysis for a conservative portfolio shows a potential 12% loss in a severe recession scenario. To specifically address this scenario risk, which fiduciary action is most appropriate? A. Increase exposure to long-duration government bonds, which tend to appreciate in recessions. B. Broaden equity holdings to include more cyclical sectors. C. Shift additional assets into high-yield corporate bonds. D. Maintain the current allocation and reassess based on next year's data. The correct answer is A. The correct answer is to tilt toward long-duration government bonds, as they typically gain value in recessionary environments, mitigating the identified scenario loss. Reason B is not correct. Cyclical sectors typically underperform in recessions. Reason C is not correct. High-yield bonds carry greater credit risk and may suffer in downturns. Reason D is not correct. Passive reassessment does not proactively mitigate scenario risk. Question 36. Which of the following best describes the primary focus of strategic asset allocation design within an investment policy statement? A. Short-term market timing to capitalize on price inefficiencies. B. Continuous rebalancing to maintain equal weights across portfolio holdings. C. Assignment of long-term target weights to broad asset classes based on risk-return objectives. D. Selection of individual securities to generate alpha relative to benchmarks. The correct answer is C. The correct answer is the assignment of long-term target weights to broad asset classes based on risk-return objectives, which is the essence of strategic asset allocation design in an IPS. Reason A is not correct. This describes tactical market timing rather than a long-term strategic approach. Reason B is not correct. Continuous rebalancing describes implementation, not the initial design of targets. Reason D is not correct. Selecting individual securities is part of implementation and manager selection, not strategic design. Question 37. Within an investment policy statement, which of the following represents a common governance limit applied to tactical asset allocation tilts? A. Requiring manager approval for any portfolio turnover above 10%. B. Mandating the use of derivatives only for hedging purposes. C. Specifying a fixed rebalancing schedule every 6 months. D. Allowing a maximum deviation of plus or minus 5% from strategic asset allocation targets. The correct answer is D. The correct answer is a maximum deviation of plus or minus 5% from the strategic targets, a typical quantitative governance limit for tactical tilts in an IPS. Reason A is not correct. Approval thresholds for turnover govern trading activity, not the magnitude of tilts. Reason B is not correct. This relates to derivatives usage rules, not to quantitative tilt limits. Reason C is not correct. A rebalancing schedule is an implementation guideline, not a tilt governance limit. Question 38. A retirement plan consultant is reviewing the equity glide path for a target date fund aimed at participants who maintain a moderate risk tolerance post-retirement. To align the glide path with this preference, the consultant should A. Begin reducing equity allocations sharply starting 5 years before retirement, then maintain a stable allocation after retirement. B. Shift equity allocation to a fixed target immediately upon retirement to lock in market gains. C. Maintain the equity allocation at pre-retirement levels through the retirement date, then decrease equity gradually over the following decade. D. Delay any equity reduction until 10 years post-retirement to preserve growth potential. The correct answer is C. The correct answer is that the consultant should hold the pre-retirement equity level through retirement and then implement a gradual reduction to match the stable risk tolerance, which balances growth and risk post-retirement. Reason A is not correct. A sharp reduction 5 years before retirement may undershoot growth needs and contradict participants' moderate risk tolerance. Reason B is not correct. An immediate shift to a fixed target neglects the gradual nature of participants' risk adjustment preferences. Reason D is not correct. Delaying reduction too long exposes retirees to excessive market risk inconsistent with moderate tolerance. Question 39. A plan sponsor allocates the core bond portfolio to a passive broad market index for stable yield and is considering a satellite allocation to enhance returns. To adhere to best practices in a core satellite structure, the sponsor should A. Select high-yield bonds in the satellite to boost yield at the core portfolio's average duration. B. Allocate the satellite exclusively to short-term government securities to reduce overall portfolio volatility. C. Use the satellite to implement a value tilt strategy in segments of the bond market not covered by the core index. D. Rotate the satellite holdings monthly to capitalize on short-term interest rate forecasts. The correct answer is C. The correct answer is using the satellite sleeve to target market segments or strategies not included in the passive core, such as a value tilt in less covered bond sectors to generate incremental returns. Reason A is not correct. Assigning high-yield bonds to the satellite may increase credit risk without clear diversification from the core index. Reason B is not correct. A satellite of only short-term government securities offers limited alpha potential compared to targeted strategies. Reason D is not correct. Monthly rotation based on rate forecasts introduces market timing risk rather than a disciplined satellite strategy. Question 40. A portfolio manager has a core allocation to large cap blend domestic equities and seeks to add style diversification. To introduce small cap growth exposure without altering the core allocation, the manager should A. Replace a portion of the large cap blend with small cap blend equities. B. Underweight domestic equity overall to accommodate the style shift. C. Shift the entire core allocation to small cap growth for higher potential returns. D. Add a satellite allocation to small cap growth equities alongside the existing core. The correct answer is D. The correct answer is to use a satellite sleeve for small cap growth, preserving the integrity of the large cap blend core while gaining exposure to the desired style factor. Reason A is not correct. Replacing with small cap blend alters the core exposure and does not achieve the targeted style tilt. Reason B is not correct. Underweighting domestic equity reduces total equity exposure rather than adding the specific style segment. Reason C is not correct. Converting the entire core to small cap growth undermines the large cap core objective. Question 41. A global equity portfolio currently holds developed markets outside North America and seeks exposure to emerging markets. To manage currency risk while enhancing diversification, the portfolio manager should A. Fully hedge all emerging market currencies to the base currency. B. Avoid hedging since local currency swings may boost long-term returns. C. Implement partial hedges for emerging market currencies based on correlation metrics. D. Hedge only the most volatile emerging market currencies and leave others unhedged. The correct answer is C. The correct answer is to use a rules-based partial hedge approach guided by currency correlations, balancing diversification benefits with currency risk control. Reason A is not correct. Fully hedging removes currency diversification benefits that can enhance returns over time. Reason B is not correct. Total avoidance of hedging ignores potential downside from currency volatility. Reason D is not correct. Selective hedging of only the most volatile currencies lacks a systematic basis for risk control. Question 42. When performing an organizational stability review of an external investment manager, which measure most directly reflects the consistency of the manager's leadership team? A. Number of new strategies launched in the past 12 months. B. Average tenure of senior portfolio decision makers. C. Variance of quarterly returns relative to the assigned benchmark. D. Frequency of updates to the investment policy statement. The correct answer is B. The correct answer is average tenure of senior portfolio decision makers, as it directly indicates stability in the leadership team and thus continuity in investment oversight. Reason A is not correct. The number of new strategies launched does not indicate leadership continuity, but product development activity. Reason C is not correct. Return variance measures performance volatility rather than leadership stability. Reason D is not correct. Policy updates reflect administrative processes, not the consistency of leadership personnel. Question 43. Which event exemplifies key person risk that could most directly disrupt an ongoing investment strategy? A. Temporary suspension of trading in an illiquid asset class. B. Unexpected departure of the lead portfolio manager without a defined succession plan. C. Revision of fee schedules in response to market competition. D. Minor organizational restructuring of back-office support teams. The correct answer is B. The correct answer is the unexpected departure of the lead portfolio manager without a defined succession plan, which embodies key person risk by threatening continuity of strategy execution. Reason A is not correct. A trading suspension relates to market liquidity, not the loss of critical personnel. Reason C is not correct. Fee schedule revisions are operational changes, not personnel-dependent risks. Reason D is not correct. Back-office restructurings typically have limited impact on investment decision continuity. Question 44. A plan fiduciary is evaluating an external equity manager whose written philosophy emphasizes disciplined value investing, with a focus on undervalued securities. However, recent portfolio updates show frequent purchases of momentum-driven stocks when market sentiment is positive. Which finding best indicates the manager's philosophy remains aligned with the fund's growth-oriented, value-based IPS? A. Regular attribution reports comparing active holdings to a recognized value benchmark. B. Tactical shifts toward high-momentum securities during broad market rallies. C. Quantitative exclusion screens that remove securities trading above historical valuation multiples. D. Targets for quarterly outperformance relative to a growth sector index. The correct answer is C. The correct answer is to use exclusion screens based on valuation multiples, which demonstrates adherence to a value discipline consistent with the IPS's growth-focused value investing philosophy. Reason A is not correct. Attribution reports alone do not confirm that portfolio decisions adhere to value criteria rather than momentum trends. Reason B is not correct. Tactical momentum shifts contradict the stated value investing philosophy in the IPS. Reason D is not correct. Focusing on quarterly growth sector outperformance favors momentum over long-term value consistency. Question 45. During due diligence, a fiduciary notes that a manager claims to employ bottom-up fundamental analysis, but sources most projections from third-party machine learning models and rarely exercises analyst overrides. Which concern most directly challenges the integrity of the stated research process? A. Third-party data inputs improve objectivity in security selection. B. Limited use of analyst discretion could reduce process transparency. C. Machine learning forecasts enhance the robustness of proprietary research. D. Over-reliance on external quantitative models may undermine fundamental stock analysis. The correct answer is D. The correct concern is that depending heavily on external quantitative models can compromise the depth of fundamental analysis, contradicting the manager's bottom-up research claim. Reason A is not correct. Objectivity is beneficial but does not resolve inconsistencies with the claimed fundamental analysis. Reason B is not correct. Limited analyst overrides raise a transparency question but do not directly contradict the core research methodology. Reason C is not correct. Enhanced robustness is an advantage but does not address a mismatch with the stated bottom-up process. Question 46. A fiduciary observes that an equity manager's risk parity optimization has resulted in overweight positions in defensive sectors, whereas the IPS specifies equal sector exposures. Which change best realigns the portfolio construction approach with the IPS requirements? A. Remove all sector constraints to allow full optimization flexibility. B. Increase allocations to defensive sectors to match IPS risk parameters. C. Adjust volatility targets to minimize sector deviations. D. Implement sector weight constraints within the risk parity optimization framework. The correct answer is D. The correct solution is to add specific sector weight constraints to the optimization, ensuring equal exposures as prescribed by the IPS while maintaining the risk parity approach. Reason A is not correct. Removing constraints exacerbates the misalignment with the IPS's sector exposure limits. Reason B is not correct. Increasing defensive allocations further deviates from the IPS's equal weight mandate. Reason C is not correct. Altering volatility targets may reduce tilts but does not guarantee equal sector weights. Question 47. In reviewing a manager's risk framework, a fiduciary notes that one-year historical VAR at 95% confidence is used for the entire portfolio, despite significant allocations to illiquid private assets. Which adjustment most effectively incorporates liquidity risk into the manager's risk assessment? A. Switch to a one-day VAR measure to capture daily price swings. B. Raise the confidence level from 95% to 99% while maintaining the same data set. C. Adopt a liquidity-adjusted VAR that extends holding periods for less liquid holdings. D. Continue relying solely on historical returns without further scenario testing. The correct answer is C. The correct adjustment is to implement a liquidity-adjusted VAR that accounts for longer liquidation horizons of illiquid assets, thereby aligning risk measures with actual asset liquidity profiles. Reason A is not correct. A one-day VAR underestimates the impact of longer liquidation horizons on illiquid holdings. Reason B is not correct. Increasing confidence without liquidity adjustment fails to address illiquid asset risk. Reason D is not correct. Relying only on historical returns does not incorporate forward-looking liquidity considerations. Question 48. Under ERISA, Section 404, subsection C Safe Harbor, participants must be allowed to direct investment of plan assets and transfer among alternatives at least how often? A. Monthly. B. Semi-annually. C. Quarterly. D. Annually. The correct answer is C. This option is correct because ERISA Section 404, subsection C requires that participants be permitted to change their investment selections and transfer assets among available alternatives at intervals no less frequent than quarterly to qualify for the safe harbor. Reason A is not correct. Requiring monthly changes is more frequent than the minimum interval specified. ERISA Section 404, subsection C, sets quarterly as the threshold. Reason B is not correct. Allowing only semi-annual transfers is less frequent than the quarterly minimum and would not satisfy the safe harbor. Reason D is not correct. Annual transfers are too infrequent to meet the at least quarterly requirement under ERISA Section 404, subsection C. Question 49. A 401k plan sponsor did not designate an investment option for participants who failed to make elections. The sponsor intends to use a qualified default investment alternative QDIA safe harbor. Which of the following investment options is not eligible to be used as a QDIA under DOL regulations? A. Target date fund. B. Balanced fund. C. Managed account service. D. Corporate bond fund. The correct answer is D. Qualified default investment alternatives under the DOL safe harbor include target date funds, balanced funds, and managed accounts. A plain corporate bond fund does not meet the QDIA diversification and glide path requirements. Reason A is not correct. Target date funds automatically adjust asset mixes over time and meet the QDIA safe harbor criteria. Reason B is not correct. Balanced funds offer a fixed mix of asset classes and are explicitly listed as a QDIA type. Reason C is not correct. Managed account services tailor asset allocations to individual participant data, qualifying as a QDIA. Question 50. An employer selects a target date fund series as its QDIA for new hires who do not make deferral elections. Under the DOL safe harbor, which feature must the chosen target date fund include to qualify as a QDIA? A. A static allocation based on the average age of participants. B. A premixed portfolio that automatically adjusts its mix of stocks and bonds over time toward the target retirement date. C. An option allowing participants to elect their own risk level each year without default reallocation. D. a requirement to maintain a minimum 30% allocation to bonds regardless of the target date. The correct answer is B. To qualify as a QDIA, a target date fund must be a pre-mixed portfolio with an asset mix that automatically becomes more conservative over time as the target date approaches, typically through a glide path. Reason A is not correct. A static allocation does not adapt over time to retirement proximity, so it fails the automatic glide path requirement. Reason C is not correct. Participant elections without automatic reallocation do not satisfy the default target date fund mechanics required by the safe harbor. Reason D is not correct. Mandating a fixed bond allocation irrespective of the target date conflicts with the gradual shift toward conservatism required by the glide path. Question 51. A plan sponsor is considering a balanced fund as its default option under the QDIA safe harbor. Which of the following must the balanced fund include to qualify under DOL rules? A. At least 75% of assets in domestic equity securities. B. A fixed allocation among at least 3 core asset classes with automatic rebalancing at least quarterly. C. An option for participants to change the allocation without waiting for a rebalance. D. A minimum average maturity of no more than 5 years for all fixed income holdings. The correct answer is B. Under the QDI, a safe harbor, a balanced fund must hold a fixed target allocation across at least 3 core asset classes. For example, equities, fixed income, international, and automatically rebalance at least quarterly to maintain that mix. Reason A is not correct. A heavy domestic equity focus neglects the required diversification across multiple core asset classes. Reason C is not correct. Participant-driven allocation changes conflict with the safe harbor's requirement for fixed target allocations and automatic rebalancing. Reason D is not correct. While credit quality and maturity limits matter, safe harbor rules emphasize diversified asset classes and rebalancing over maturity constraints. Question 52. A retirement plan's QDI. A notice indicates that a managed account service will be used as the default for participants who don't make elections. Under the DOL safe harbor, which condition must this managed account option meet to qualify as a QDIA? A. Participants must elect their own asset allocation within 30 days. B. The management provider must serve in a fiduciary capacity under ERISA and the Investment Advisors Act. C. The account balance must be locked for at least 5 years. D. Assets are rebalanced only upon participant request. The correct answer is B. For a managed account service to qualify as a QDIA, the provider must act in a fiduciary capacity under ERISA and be registered under the Investment Advisors Act, ensuring fiduciary oversight of participant allocations. Reason A is not correct. Mandatory participant elections contradict the default nature required by the managed account safe harbor. Reason C is not correct. Locking assets for years would violate participant rights to direct their investments under ERISA. Reason D is not correct. Rebalancing only on request fails to provide the ongoing investment management service required by the safe harbor. Question 53. HR plans to mail the initial QDIA notice to employees defaulted into a target date fund. To satisfy DOL safe harbor notice rules, the notice must include which of the following elements? A. A statement guaranteeing no market losses in the QDIA. B. Instructions on how participants can direct contributions to an alternate available option. C. A projection of future returns based on past performance. D. The employer's matching contribution formula. The correct answer is B. QDI. A safe harbor notices must inform participants of their right to direct contributions to plan alternatives and provide clear instructions for making an election to opt out of the default. Reason A is not correct. No guarantee of principal protection can be provided in the notice, as QDIAs are subject to market risk. Reason C is not correct. Projections of future performance based on historical data are not required and may be misleading. Reason D is not correct. Matching contribution details are unrelated to the QDIA notice safe harbor requirements. Question 54. Within a best execution analysis framework, which execution benchmark quantifies the difference between the average price achieved on an order and the market price prevailing at the time the trading decision was made? A. Volume-weighted average price. B. Time-weighted average price. C. Closing price benchmark. D. Implementation shortfall metric. The correct answer is D. The correct answer is implementation shortfall metric. It measures the difference between the executed price and the market price at the decision point. Volume-weighted average price weights each trade by volume over a period. Time-weighted average price weights each time interval equally. And closing price benchmark compares executions to the end-of-day price rather than to the decision time price. Reason A is not correct. Volume-weighted average price is based on trade volumes over a period, not on decision time market price. Reason B is not correct. Time-weighted average price averages prices equally over time intervals, rather than anchoring to the decision price. Reason C is not correct. Closing price benchmark compares to end-of-day price, not to the price when the trading decision was made. Question 55. A defined benefit plan fiduciary is conducting due diligence on a brokerage firm to satisfy best execution obligations for equity trades. In addition to reviewing commission rates and the broker's financial strength, which additional factor is most critical for demonstrating thorough broker selection due diligence? A. Range of research services offered by the broker. B. Historical average settlement times for executed trades. C. Transparency of the broker's order routing practices. D. Brokers' participation in commission recapture programs. The correct answer is C. The correct answer is transparency of order routing practices because it directly impacts best execution by revealing potential conflicts or inferior routing. While research services, settlement times, and commission recapture participation may influence other aspects, they do not address order routing transparency, essential for due diligence. Reason A is not correct. Focusing on research services does not ensure actual execution quality or reveal conflicts in order routing. Reason B is not correct. Settlement speed has limited relevance to execution quality and does not uncover routing conflicts. Reason D is not correct. Evaluating commission recapture participation does not directly inform best execution practices or conflict identification. Question 56. An investment manager executes identical securities orders across multiple client accounts on the same trading day. Which policy best ensures allocations are fair and consistent with fiduciary duties? A. Rotate priority, so each account is first in order periodically. B. Let the portfolio manager distribute fills to preferred clients first. C. Randomly assign fills among accounts using a lottery system. D. Allocate trades on a pro rata basis based on account sizes. The correct answer is D. The correct answer is allocations on a pro rata basis because it ensures proportional fairness relative to account sizes, aligning with fiduciary duties. Rotating priority, lotteries, or discretionary fills introduce potential biases or unequal treatment. Reason A is not correct. Rotating priority may not maintain proportional fairness and adds complexity without guaranteeing equitable treatment. Reason B is not correct. Discretionary distributions favor certain clients and violate the duty of impartiality. Reason C is not correct. Random assignments can produce disproportionate outcomes and undermine consistent treatment. Question 57. A pension plan fiduciary combines multiple client orders into a single block trade to reduce transaction costs. Which practice ensures compliance with block trading procedures and fiduciary responsibilities? A. Combining only accounts with similar investment objectives for the block order. B. Allowing the executing trader to allocate shares at personal discretion. C. Delaying final allocation instructions until after trade confirmation. D. Allocating larger shares to accounts that generate higher commissions. The correct answer is A. The correct answer is combining orders only for accounts with similar objectives because it ensures uniform treatment and mitigates conflicts. Allowing discretionary allocations, delaying instructions, or favoring high commission accounts would violate procedural safeguards and fiduciary duties. Reason B is not correct. Permitting personal discretion in allocations introduces conflicts and inconsistent treatment. Reason C is not correct. Delaying instructions until after execution can lead to unfair timing advantages and non-random outcomes. Reason D is not correct. Favoring accounts based on commission generation breaches the duty of loyalty and impartiality. Question 58. A public pension fiduciary selects a transition manager to implement a large-scale asset reallocation. Which fiduciary action best demonstrates proper use of the transition manager? A. Requiring the transition manager to adhere to a written implementation schedule and benchmarks. B. Relying solely on the transition manager's provided transaction cost analysis without independent review. C. Negotiating a flat fee structure to avoid incentive conflicts based on performance outcomes. D. Allowing the transition manager to execute trades through internal brokerage affiliates only. The correct answer is A. The correct answer is requiring a written implementation schedule and benchmarks because it enables measurable oversight and accountability of the transition manager. Sole reliance on provided analysis, flat fee structures without clear deliverables, or restricting brokers to affiliates undermines independent monitoring and best execution. Reason B is not correct. Sole reliance on the manager's analysis prevents independent verification and may overlook biases. Reason C is not correct. A flat fee addresses incentives but does not ensure adherence to timeline or facilitate performance monitoring. Reason D is not correct. Restricting broker sources to affiliates creates potential conflicts and may impair best execution. Question 59. Time-weighted rate of return is most appropriate for measuring which of the following? A. Assessment of actual investor return, considering both the timing and size of external cash flows. B. Measurement of total dollar growth of an account that includes the timing of contributions and withdrawals. C. Comparative evaluation of a portfolio manager's performance with the impact of client cash flow timing, neutralized. D. Return calculation that assigns greater weight to periods in which asset balances are larger. The correct answer is C. The correct answer is a measure that isolates manager performance by neutralizing the effect of external cash flows. Time-weighted return removes the impact of contributions and withdrawals, allowing apples-to-apples comparisons of manager skill. Reason A is not correct. Considering both timing and size of cash flows pertains to money-weighted return, not time-weighted return. Reason B is not correct. This describes a measure that includes the timing of client cash flows, which is characteristic of money-weighted return, not time-weighted return. Reason D is not correct. Weighting by period asset balances reflects money-weighted methodology, whereas time-weighted return treats each sub-period equally. Question 60. Which of the following best describes the money-weighted rate of return? A. Rate of return that weights. Sub-period returns equally, unaffected by the timing of cash flows. B. Ratio of net gain to beginning portfolio value, excluding contributions and withdrawals. C. Internal rate of return that equates the present value of all external cash flows with the final portfolio value. D. Measure of active management performance relative to benchmark returns. The correct answer is C. The correct answer is the internal rate of return that equates contributions and withdrawals to the ending value, reflecting both the amount and timing of cash flows. This definition aligns with the concept of money-weighted return. Reason A is not correct. An equal weight average of sub-period returns without cash flow impact describes time-weighted return, not money-weighted return. Reason B is not correct. Excluding contributions and withdrawals ignores cash flow timing, which contradicts the money-weighted methodology. Reason D is not correct. Performance relative to a benchmark is a characteristic of measurement attribution, not money-weighted return. Question 61. A defined benefit plan has committed to a private equity fund that pays carried interest only on returns above a hurdle set at an 8% internal rate of return limit. The plan is negotiating an increase of the limit to 10%. What effect will raising the IRR limit from 8% to 10% have on the plan's expected carried interest and alignment of interests? A. It will decrease expected carried interest and weaken alignment of interests. B. It will decrease expected carried interest and strengthen alignment of interests. C. It will increase expected carried interest and strengthen alignment of interests. D. It will increase expected carried interest and weaken alignment of interests. The correct answer is B. Raising the IRR hurdle reduces the pool of returns eligible for carried interest, lowering expected fees while requiring managers to achieve higher performance before earning carried interest, thereby strengthening incentive alignment. Reason A is not correct. A higher hurdle actually improves alignment by requiring stronger performance before fees accrue, so alignment would not weaken. Reason C is not correct. Raising the hurdle makes it tougher for managers to earn carried interest, so expected carried interest cannot increase. Reason D is not correct. A higher threshold reduces, not increases, carried interest, and alignment is enhanced by the more demanding performance requirement. Question 62. A pension fund is comparing two equity portfolios. Portfolio X has an expected return of 8% and beta of 1.4 relative to the market, while Portfolio Y has the same expected return, but beta of 0.9. To assess reward per unit of systematic risk, which risk-adjusted return metric should the fund use? A. Sharpe ratio. B. Sortino ratio. C. Trainor ratio. D. Information ratio. The correct answer is C. The Trainor ratio measures excess return per unit of systematic risk, beta, making it appropriate for comparing portfolios with differing market exposures. Reason A is not correct. Sharpe ratio uses total volatility rather than systematic risk, so it is not the correct measure here. Reason B is not correct. Sortino ratio focuses on downside deviation, not systematic market risk represented by beta. Reason D is not correct. Information ratio relates active return to tracking error, not returns per unit of beta. Question 63. A foundation evaluates two balanced portfolios over the past year. Portfolio A returned 6% with a standard deviation of 8%. Portfolio B returned 5% with a standard deviation of 5%. Assuming a risk-free rate of 1%, which portfolio has the higher Sharpe ratio? A. Portfolio A has the higher Sharpe ratio. B. Portfolio B has the higher Sharpe ratio. C. Both portfolios have an equal Sharpe ratio. D. Cannot be determined without covariance data. The correct answer is B. Portfolio B's Sharpe ratio is 5% minus 1% divided by 5% equals 0.8, which exceeds Portfolio A's 6% minus 1% divided by 8% equals 0.625. So Portfolio B has the higher risk-adjusted return. Reason A is not correct. Portfolio A's higher volatility relative to its excess return yields a lower Sharpe ratio than Portfolio B. Reason C is not correct. The computed values of 0.625 and 0.8 are not equal. Reason D is not correct. Covariance data are unnecessary since the Sharpe ratio uses standard deviation and average return only. Question 64. An endowment's global equity manager achieved an active return of 4% over the benchmark with a tracking error of 5%. What does an information ratio of 0.8 indicate about the manager's performance? A. The manager's alpha is 0.8% over the risk-free rate. B. The manager underperformed the benchmark by 0.8% after accounting for risk. C. The portfolio's returns and benchmark returns have a correlation of 0.8. D. The manager generated 0.8% of excess return for each unit of tracking error, indicating strong skill in adding value. The correct answer is D. An information ratio of 0.8 means the manager delivered 0.8 percentage points of active return for each percentage point of tracking error, reflecting strong value-adding skill relative to the benchmark. Reason A is not correct. Alpha is absolute excess return, whereas this metric is active return divided by tracking error. Reason B is not correct. The manager's active return was positive, so underperformance is not implied. Reason C is not correct. Information ratio measures return per unit of risk, not correlation. Question 65. A pension plan regresses a fund's monthly returns against its benchmark and finds a beta of 1.2. What does this beta estimate imply about the fund's volatility relative to the benchmark? A. The fund's alpha is 1.2%. B. The fund is 20% less volatile than the benchmark. C. 80% of the fund's returns are explained by the benchmark. D. The fund is 20% more volatile than the benchmark. The correct answer is D. A beta of 1.2 indicates the fund's returns move 20% more on average than benchmark movements, signifying higher volatility relative to the benchmark. Reason A is not correct. Alpha is the regression intercept representing abnormal return, not beta. Reason B is not correct. A beta greater than 1 denotes higher, not lower, volatility relative to the benchmark. Reason C is not correct. R squared, not beta, measures the proportion of returns explained by the benchmark. Question 66. During the quarter, a portfolio was overweight financials by 3% relative to its benchmark. The benchmark's financial sector return was 6%, while the portfolio's financial sector return matched the benchmark. What was the allocation effect of financials on the portfolio's relative performance? A. Negative 0.18%. B. Positive 0.18%. C. Positive 0.06%. D. Negative 0.06%. The correct answer is B. Allocation effect equals the weight difference. 3% multiplied by the benchmark sector returns 6%, yielding a positive 0.18% contribution to relative performance. Reason A is not correct. A positive overweight in a sector with positive benchmark return yields a positive, not negative, allocation effect. Reason C is not correct. Positive 0.06% reflects a 1% overweight at 6%, not the 3% overweight used here. Reason D is not correct. A negative effect would require an underweight or negative sector return, neither of which applies. Question 67. According to typical fiduciary oversight guidelines, an investment manager is placed on a watch list for underperforming its benchmark by more than how many basis points over a trailing 36-month period? A. 100 basis points. B. 150 basis points. C. 200 basis points. D. 250 basis points. The correct answer is C. The correct answer is 200 basis points, as most fiduciary oversight guidelines set the watch list threshold at underperformance, exceeding 200 basis points over a 36-month rolling period. Reason A is not correct. This threshold is too low. Guidelines typically require a larger performance gap before watchlist placement. Reason B is not correct. Underperformance of 150 basis points falls below the standard criterion for watchlist placement. Reason D is not correct. A 250 basis point threshold exceeds the commonly accepted level, making watchlist placement less likely at that level. Question 68. Under typical fiduciary quantitative scorecard thresholds, an investment manager enters watchlist monitoring when its performance falls at or below which percentile rank of its peer universe over a rolling 12-month period? A. 10th percentile. B. 25th percentile. C. 50th percentile. D. 75th percentile. The correct answer is B. The correct answer is the 25th percentile, as quantitative scorecard thresholds commonly place managers on watchlist monitoring when performance ranks at or below the bottom quartile of their peer group. Reason A is not correct. A 10th percentile ranking is more extreme than standard watchlist criteria and often prompts more immediate action. Reason C is not correct. Median performance, 50th percentile, is above the threshold that triggers watchlist monitoring. Reason D is not correct. Performance at or below the 75th percentile includes most managers and exceeds typical watchlist thresholds. Question 69. A fiduciary reviews a quarterly report from an equity manager that lacks any commentary on sector risk exposures, a qualitative concern identified in recent oversight. Which action best addresses this red flag? A. Request a supplemental narrative that details sector exposures and risk management processes. B. Adjust the equity allocation to underweight high volatility sectors. C. Engage an external consultant to audit the manager's performance metrics. D. Suspend new capital contributions to the manager pending review. The correct answer is A. The correct answer is to request a supplemental narrative because it directly addresses the oversight concern by obtaining detailed sector and risk management commentary to satisfy fiduciary documentation requirements. Reason B is not correct. Adjusting allocations does not resolve the missing qualitative explanation of sector risks. Reason C is not correct. An external audit focuses on performance data rather than providing the missing risk commentary. Reason D is not correct. Suspending contributions is overly drastic and does not address the documentation deficiency. Question 70. During routine monitoring, a fiduciary notes 3 senior analysts have left a fixed income manager within 2 quarters. Which step best addresses this personnel turnover escalation? A. Request the manager's documented succession and staffing continuity plans. B. Reduce the allocation to the manager until new analysts are hired. C. Require the manager to provide past performance data for new hires. D. Terminate the relationship immediately to avoid future disruptions. The correct answer is A. The correct answer is to request succession and continuity plans because it allows assessment of how the manager intends to maintain service quality despite turnover. Reason B is not correct. Reducing allocation prematurely may penalize the strategy without understanding continuity measures. Reason C is not correct. Past performance of hires is unavailable and irrelevant to continuity planning. Reason D is not correct. Immediate termination is overly reactive without evaluating the manager's mitigation strategies. Question 71. A large cap equity manager is acquired by a private equity firm, changing its ownership structure. Which action should the fiduciary take first in assessing this ownership change? A. Review the acquisition agreement to evaluate potential conflicts of interest and control changes. B. Immediately benchmark the manager's performance against a new index. C. Request a third-party valuation of the equity portfolio holdings. D. Reallocate all assets to a different manager with stable ownership. The correct answer is A. The correct answer is to review the acquisition agreement because it identifies shifts in governance and conflict risk that impact fiduciary oversight. Reason B is not correct. Rebenchmarking does not address the ownership and governance implications of the acquisition. Reason C is not correct. A third-party valuation focuses on holdings value rather than control structure changes. Reason D is not correct. Reallocating assets without analysis may eliminate a viable manager without assessing risk. Question 72. An investment manager self-reports a minor compliance breach related to trade reporting errors. What is the most appropriate fiduciary follow-up? A. Obtain the manager's written remediation plan and verify implementation timelines. B. Terminate the mandate immediately to avoid ongoing compliance risk. C. Adjust performance benchmarks to reflect the reporting errors. D. Conduct a client survey on the manager's reputation. The correct answer is A. The correct answer is to obtain and verify a remediation plan because it ensures the breach is addressed and controls are improved in line with fiduciary duty. Reason B is not correct. Immediate termination is disproportionate for a minor self-reported error without assessing remediation. Reason C is not correct. Adjusting benchmarks does not correct compliance control deficiencies. Reason D is not correct. A client survey does not address the underlying compliance issue or prevent recurrence. Question 73. Following an SEC exam that identified inadequate trade documentation procedures, what is the fiduciary's best next step for remediation oversight? A. Review the manager's corrective action report and confirm updated procedures are in place. B. Switch to a manager that has no recent SEC findings. C. Request historical audit results from prior regulators. D. Increase the portfolio's cash allocation until documentation improves. The correct answer is A. The correct answer is to review the corrective action report and verify procedure updates because it directly addresses the exam findings under fiduciary monitoring requirements. Reason B is not correct. Replacing the manager ignores the possibility that the identified issues have been corrected. Reason C is not correct. Historical audit results do not confirm current procedural remediation. Reason D is not correct. Increasing cash allocation does not resolve documentation deficiencies. Question 74. According to the AIF framework's all-in fee calculation methodology, the total portfolio cost is derived by summing the advisory management fee, the asset-weighted average expense ratio of underlying investment vehicles, and which additional component? A. Annual custodial safekeeping and reconciliation expenses. B. Performance-based incentive management and bonus fees. C. Administrative record-keeping and data processing charges. D. Estimated portfolio transaction costs expressed in basis points. The correct answer is D. Estimated portfolio transaction costs are the additional component included, along with advisory fees and asset-weighted expense ratios in the all-in fee calculation. Reason A is not correct. Custodial safekeeping and reconciliation expenses are separate plan operations costs not included in the all-in fee calculation. Reason B is not correct. Performance-based incentive fees are not part of the standard all-in fee methodology. Reason C is not correct. Administrative record-keeping and data processing charges relate to service provision rather than portfolio cost calculations. Question 75. Under AIF's fee reasonableness comparative data guidelines, which source is most appropriate for evaluating whether an investment fee aligns with prevailing market levels for similarly sized institutional portfolios? A. Use historical plan fee levels over the 3 preceding fiscal years. B. Use internal multi-year pro forma budget forecasts prepared for departmental and operational planning purposes. C. Use a third-party survey of average all-in fees by comparable plan size, asset allocation, and manager type. D. Use broad market equity and fixed income index return benchmarks. The correct answer is C. A third-party survey of average all-in fees by comparable plan size, asset allocation, and manager type provides the external peer data required to assess fee reasonableness under AIF standards. Reason A is not correct. Historical internal fee trends do not provide a current market comparison. Reason B is not correct. Internal budget forecasts lack the external market perspective needed for fee reasonableness assessments. Reason D is not correct. Index return benchmarks relate to performance, not fee levels. Question 76. Under AIF guidelines, how must a fiduciary treat revenue-sharing rebates to adhere to prudent cost allocation? A. Credit revenue-sharing rebates directly back to the plan sponsor or plan participants. B. Retain revenue-sharing rebates to offset future advisory fees charged to the plan. C. Allocate revenue-sharing rebates to a discretionary reserve fund for administrative contingencies. D. Redeploy revenue-sharing rebates into higher-yielding alternative investment strategies for the plan. The correct answer is A. AIF guidelines require fiduciaries to credit revenue-sharing rebates back to the plan sponsor or participants as fee credits, ensuring transparent cost allocation. Reason B is not correct. Retaining rebates to offset advisory fees fails to return the benefit to the plan or participants. Reason C is not correct. Allocating to a discretionary fund does not directly benefit the plan sponsor or participants. Reason D is not correct. Redeploying rebates into other investments bypasses returning value to the plan. Question 77. An investor enrolled in a wrap fee program pays a 1.20% annual advisory fee that includes execution costs. The underlying mutual funds in the program have an average expense ratio of 0.40%. Alternatively, the investor could use an unbundled account charging a 0.60% advisory fee plus $12 per trade. To determine which structure is more cost-effective over the next year, the fiduciary should A. Compare only the number of trades executed under each structure. B. Compare only the difference in advisory fee percentages and ignore fund expense ratios. C. Compare only the average mutual fund expense ratios under each program. D. Compare the total projected trading commissions and advisory fees under the unbundled account to the 1.20% wrap fee. The correct answer is D. The correct answer is to aggregate both the projected per-trade commission costs and advisory fees under the unbundled account, and compare that total to the wrap fee percentage to determine true all-in cost. Reason A is not correct. Comparing only trade counts omits the per-trade commission rate and advisory fee, so it fails to reflect total costs. Reason B is not correct. Ignoring fund expense ratios understates the true cost differential between wrap and unbundled programs. Reason C is not correct. Focusing solely on fund expense ratios ignores advisory and execution costs, which are material components under both programs. Question 78. A retirement plan currently holds retail share classes of mutual funds that charge 0.25% 12b1 fees. The fiduciary is evaluating options to eliminate these ongoing fees without materially changing the investment lineup. The most efficient strategy is to A. Negotiate with the broker-dealer to rebate a portion of the 12b yield 1 fees back to the plan. B. Switch to A share classes that impose upfront sales charges instead of ongoing 12b1 fees. C. Convert the plan's retail shares to no-load institutional share classes that have no 12b1 fees. D. Move assets into a separate account structure that replicates the same funds at lower cost. The correct answer is C. The correct answer is to convert to institutional share classes which are designed to eliminate 12b1 fees while maintaining the same investment strategies and manager access. Reason A is not correct. Rebating 12b1 fees relies on counterparty negotiation and doesn't eliminate the fees themselves. Reason B is not correct. Switching to A shares adds upfront sales charges, which may increase total costs rather than eliminate ongoing fees. Reason D is not correct. A separate account structure often has higher operating and customization expenses that offset any fee savings. Question 79. A plan sponsor reviews a transaction cost analysis report showing trade executions against VWAP and arrival price benchmarks. To capture both explicit commissions and implicit market impact costs for each block trade, the fiduciary should emphasize which metric? A. VWAP slippage, which measures execution price relative to volume-weighted average price. B. Implementation shortfall, which measures total cost from decision price to execution price. C. Average execution price, which measures only the price paid compared to midpoint. D. Turnover ratio, which measures trading frequency but not execution quality. The correct answer is B. The correct answer is implementation shortfall, as it captures both explicit and implicit costs by comparing the execution price to the decision or arrival price over the full trade. Reason A is not correct. VWAP slippage ignores costs relative to the decision price and doesn't fully capture market impact. Reason C is not correct. Average execution price does not benchmark against the decision price or account for opportunity cost. Reason D is not correct. Turnover ratio indicates how often assets trade but provides no direct measure of cost efficiency. Question 80. A fiduciary compares two trading venues for equity execution. Venue X charges a 0.2 cents access fee but provides a 0.1 cents average price improvement. Venue Y charges a 0.1 cents access fee with no price improvement. To determine which venue is more cost-efficient, the fiduciary should focus primarily on A. Latency and speed of execution, which influences timeliness but not direct cost. B. Quoted bid-ask spread, which reflects liquidity but not actual trade costs. C. Frequency of price improvement opportunities, which may occur irregularly. D. Net execution cost, which combines access fees and price improvement against the benchmark price. The correct answer is D. The correct answer is net execution cost, since it directly measures the combined effect of access fees and price improvements relative to a benchmark price. Reason A is not correct. While execution speed affects trading performance, it doesn't directly quantify overall cost efficiency. Reason B is not correct. Quoted spreads don't reflect the actual access fees or price improvements realized on executed trades. Reason C is not correct. Frequency data alone doesn't translate into total cost without quantifying fee and improvement magnitudes. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below. We read them all. Find full practice exam books in the description or at ExamPrep.School.